In this screencast, we're going to talk about monetary policy with limited reserves and the impact that it has on the policy rate. We'll also understand how the buying of bonds increases the money supply. We've gone over in a previous screencast the three tools of monetary policy. Just as a review, the central bank could change the discount rate. And remember, the discount rate is the interest rate that the Fed charges a member bank for taking out a loan. The central bank could also change the reserve requirement, or they could participate in open market operations. Open market operations is the buying and selling of government bonds. So let's take a look at expansionary monetary policy. In a previous screencast, we talked about how when the central bank buys bonds, this increases the supply of excess reserves. When banks loan out those excess reserves, that will increase the money supply. When the money supply shifts to the right, that will decrease the nominal interest rate. And when the nominal interest rate goes down, that will increase interest-sensitive spending like consumption and gross private investment. When those increase, that will increase the aggregate demand, which, as displayed on the ADAS model, increases the price level, it increases real GDP, and it decreases unemployment. The main goal of central banks in using monetary policy is to target the policy rate. So the policy rate is also known as the interbank lending rate, and in the United States, the policy rate is the federal funds rate. If you recall, the federal funds rate, again, that interbank lending rate, is the interest rate that one bank would charge another bank to take out a loan. So if you look here on our reserve market graph, we've got the supply of reserves and we have the demand for reserves. Because it's a limited reserves framework, we are looking at the downward sloping part of the demand curve. So when there is an increase in the supply of excess reserves, this is going to cause the supply of reserves to shift to the right, which will decrease the policy rate. When you have a decrease in the policy rate, or the federal funds rate in the United States, for example, that means then that the interest rate that banks are charging each other is lower, and so therefore they will take out more loans, which will in turn increase that money supply. Another takeaway to take about expansionary monetary policy is that this is causing an increase in the money supply with the buying of bonds. Now, I know that the monetary base will go up because the monetary base, remember, is money in circulation and reserves. And so here you have the increase in the excess reserves when the central bank is buying bonds from the banks. But not only are you having that increase in the excess reserves, which gets loaned out, but don't forget about the money multiplier. So the money supply will be larger than the increase in monetary base when we're talking about the central banks buying bonds.